Imagine this. You've been saving for a home. You've been looking at all of the listings. You've been dreaming about where you're going to put the furniture. And then one decision changes everything. You buy a new car. Now, buying a car isn't a bad thing, but if you're planning to buy a home soon, that shiny new car payment could reduce how much of a house you can afford or qualify for. And this may altogether prevent you from being able to be qualified for that price point. Today I'm going to dive in. I'm going to explain how it really works from a lending standpoint, how that car payment impacts what we call a debt to income ratio. And if you're a buyer on the hunt, you're going to need to know this. But first, I got a story. So one of my very dear friends was in this same boat. Like, some of the best content, it just really does come from real life examples, and this is no different. So with my friend, I'm not going to say her name, but she has been wanting to buy a home and had been doing all the things I just talked about, just getting so excited, and she's got little boys, and what is this going to look like, and they're going to get a dog and all the things. And then she went and bought a car on that fateful Sunday. And that day changed the course of when she was going to be able to buy a house. Because that payment, and this is what a lot of people don't understand, that payment, as it gets calculated into a debt to income ratio, it put her over the threshold to qualify for that price point on that home that she had dreamed of. So that's just a great example of pausing and talking to your lender before you go buy the car. Because in this case, had she not had that understanding of a payment range when she went to the car dealership to buy that next car, she could have been in the same position, and she wasn't. That's just what the relationship is. And talking to that lender and being able to just be able to be like, I want to do this. They have all the facts. They understand how it works from a qualification standpoint, and they can help you walk through real life scenarios. So remember my friend, guess what? That lease expired, and in 3 years, she came back to me and said, okay, my lease is coming up. I want to buy a home and I don't want to mess it up. What payment can I qualify for with a car before I go buy it that will help me buy this price point of a house? And guess what? Just that one change in her approach changed everything. She was able to buy her first home, and she is now a very proud homeowner. So today I really want to share with you just like what a debt to income ratio is. And it's really that, right? Lenders talk about a DTI. Well, that stands for debt to income ratio. So check out the example of my chicken scratch on how I walk you through it. I'm going to do a quick down and dirty how a lender calculates a debt ratio. Now realize that the loan program that you're applying for will have a different debt to income ratio calculation, or max debt to income ratio. But for now, we're just going to make some assumptions. So we're going to assume that this is a conventional conforming loan with a 50% max debt to income ratio. So let's say that the usable income for our borrower is $5,000 per month. That's gross income, and that's what we're using from a lending standpoint. Now, I want you to think that at a 50% debt ratio, the maximum that all of that buyer's expenses can be is $2,500, all right? So that's at a 50% debt to income ratio, right? So now, what does that really mean to you? Well, if you want to buy a house, and let's say your estimated monthly payment is $2,000 a month, and that payment would include principal and interest, mortgage insurance, property taxes, homeowners insurance, as well as a homeowner association if you're buying in a community that has one. So let's say for this example that your housing payment is going to be $2,000 per month. Well, this tells you that if your maximum with your total payments, so that's going to include housing, any car payments, credit cards, student loans, alimony, child support, if that maximum that you can have is $2,500 in this scenario, and your house payment is $2,000 a month, then you are left with not being able to exceed $500 a month on your other ancillary debts. So in this case, if you have a car payment that's $450 a month and you have a credit card payment where the minimum payment is, let's say, $30 a month, then you're at $480 a month, which means you're still qualifying at that 50% debt ratio. Now, where it gets off is, let's say that you want to buy a house where your payment's $2,000 a month, but your other debts are $1,000 a month.
So maybe that car payment is $700 a month, and maybe your minimum payments on your credit cards are $300 a month. In this scenario, now your monthly expenses are $3,000 a month. If you divide $3,000 into $5,000, you're now at a 70% debt to income ratio. And guess what? You will not qualify.
It is really one of the most important drivers of what is going to drive that price point, your down payment, what your payment threshold is to qualify for a house. And so if you're in that mode of like, I know I'm going to need to buy a car, but I also want to buy a house, just stop, back it up. Talk to the lender first, and they're going to be able to tell you, okay, today, maybe without a car payment or your existing car payment, here's what you could qualify for based on your scenario with your down payment, etc. But you can also say, and hey, by the way, I want to buy a new car. I'm thinking a targeted payment of X. How will that impact my ability to qualify for this same price point, same down payment, etc.? And you're going to know the facts before you go and shop and get all excited about that car, and then it crushes your dreams. Hopefully this was helpful. If you have any questions about just how debt to income ratios work, don't hesitate to call or text 480-725-0150. The Kelly Zitlow Group is here. We have very caring mortgage advisors that are going to ask you the right questions and be sure that you're being set up for success.